So let's hear it for the January effect. The Dow was up 3% in January, about 3%. The S&P was up about 6%. And the NASDAQ was up about 11% for the month of January 2023. All right. Let's see. At that rate, the Dow should be up 36% this year. The S&P should be up 72%, and the NASDAQ will be up 132%. That's my prediction. No, I'm only kidding. Not my prediction. Actually, I don't think that's going to happen. But it was nice to have a good month for a change, especially because the stock and bond market had such a dismal 2022. Well, I'm Steve Wolf, and this is the market recap for the month of January 2023. It seemed like the market came out of nowhere to blow out the doors in January, but there is something known as the January effect that might have had a hand in this. So what is the January effect? Well, before I tell you what it is, please remember that whatever is being said here is for informational purposes only and is not meant to be a recommendation. Before you buy or sell anything related to anything I'm saying about the markets or individual securities, be sure to consult your financial consultant to ensure that it's the best recommendation for your particular personal situation. All right, so what's the January effect? Well, according to an article in TheStreet.com, some believe that an anomaly happens in the markets during the first month of the year. It's when prices of small cap stocks, in particular having declined in late December, rise again in early January, hence the name January effect. Duh. The January effect was first noticed by an investment banker whose name was Sidney Wachtell back in 1942. Wachtell observed that since 1925, and I guess that meant from 1925 to 1942, the small cap stocks not only tended to rise in January, but they also seemed to consistently outperform large caps in that particular month. Now, another study, which accounted for a 70-year stretch of the market performance between 1904 and 1974, concluded that small cap returns were 5 times greater on average in the month of January. Another study by Solomon Smith Barney, which, by the way, is a firm I worked for, and in case any of you are wondering, I'm an old guy. I started out with E.F. Hutton way back in the 1980s. And for you old timers like me out there, you're probably going, okay, I'm listening. And for you young people who don't understand what I just said, go on the internet, look up E.F. Hutton commercials, and you'll see exactly what I mean. And that was popular during that time frame. Anyway, as Solomon Smith Barney's study examined more contemporary stock market performance between 1972 and 2000, it found that small caps, as measured by the Russell 2000, still outperformed large caps, as measured by the Russell 1000 index, in January, but by a much smaller margin, just 0.82%. Now, many believe that once the January effect became widely known, it stopped working, and that happens a lot. All of a sudden we say, oh, this happens during this time, and then everybody knows it, it stops working. But there are 4 possible causes for the January effect. One is tax loss harvesting. Now, what's tax loss harvesting? It's pretty simple. At the end of the year, you might have some stocks or some funds or whatever that have lost money during the year. And last year there was a lot, especially in the growth area, in the tech area. So rather than just letting that go to waste, a lot of people in their taxable accounts said, let's take the loss because I can take it against my gains so I would pay less taxes. That's what tax loss harvesting is. Then there's something called window dressing. Now, the window dressing is something that the institutions and mutual funds sometimes do. What is that? That means at the end of the year, they buy stocks that have done really well for the year and sell off some of their losers. And this makes their portfolio look better, I guess, to investors. I'm not really sure it's the greatest thing to do, but they do it. Then you have year-end bonuses. That's another thing as far as the January effect. A lot of times people get their bonuses at Christmas time or the end of the year, and they have that money to spend or to invest, and a lot of them invest. And then finally, there's investor sentiment. Well, investor sentiment was really bad last year, but in January, it seemed to have turned. Now, January rallies on their own are generally a good sign for the rest of the year. According to Ned Davis Research, when the S&P 500 posts a gain for the first month of January, it goes on to rise another 8.6% for the year on average. Now, these figures date back to about 1929. This year was really something, though. The S&P achieved a so-called trifecta. For you gamblers out there, you know what a trifecta is. It's a rally, in this particular case, It's a rally for the final 5 trading days of a year and the first 2 trading days of the next year. That's 1. A gain over the first 5 trading days of the new year. That's 2. And for the 3, a rally for January. And guess what? We had a terrific rally for January. When the S&P does all of that, after a year that saw a bear market, which we define as a 20% drop or more from a high, the index's average gain for the rest of the year is 13.9% on average. Now, it posted positive returns in almost all the 17 post-bear trifecta years. So that may be a good sign for this year. It's not a guarantee, but it may be a good sign. While the January effect is fun to talk about, I think what happened in January was really more about the inflation rate starting to come down and the hope that the Fed would finally stop raising rates. I also believe that some of the things we talked about with the January effect were actually in place. For instance, there was a ton of tax loss selling last year. And why not? I mean, so many stocks were down by a lot. If you could in your taxable account take the loss, then you probably should. And a lot of taxpayers took advantage of that. Now, that put some of the valuations of a lot of these stocks at a very depressed level, so there was definitely room to run at the beginning of this year. Now, I don't know if the mutual funds and the institutions did window dressing. I have no idea if the year-end bonuses had any effect, but I do think that investor sentiment changed, and to a much more positive tone as they looked at inflation numbers coming down. Now, how positive was it? Sounds like the old Johnny Carson show. So, how positive was it? At any rate, and that goes back again. You old-timers will know that. I should stop talking to the old-timers. You young people, go look it up on the internet. Johnny Carson. Well, CNN Business has a fear and greed index it publishes. I'm not going to go into all the factors that they use, but the index goes from 0 to 100, with 0 being extreme fear and 100 being extreme greed. The reading at the end of January this year was at 76. That's in extreme greed territory. Now, just to give you a comparison, last year, at this time of the year, the index was at 26, and that's almost entering extreme fear territory. So 76 now, 26 then. Investor sentiment definitely changed. Now, there were a lot of stocks that ripped to the upside here in the beginning of the year, and most of those were some of the riskier stocks and some of the tech stocks and whatever that had been really hurt back in 2022. Now, according to Keith Lerner of Truist, at the end of January, the 50 worst performing stocks of 2022 were up an average of 20.1% for the month. The 50 best performing stocks of 2022 were up just 1.9% in January. Now, I can tell you that a lot of those stocks that were the 50 worst, they probably were down by 30, 40, 50. Some were down 60, 70%. So had a lot of room to run. Lerner also noted that price to earnings ratios, or PEs, are going up more on hopes probably that the Fed is going to stop raising rates. So PEs were being pushed up in January. And remember, the stock market is a forward-looking instrument. So although we may be going into a recession, slight recession, slowdown, whatever it is, people start looking ahead of that. Last year, they put in all the bad news, and now time has gone on, and so people are starting to look ahead. Investors are starting to look ahead, and that's what that's all about. Lerner also said that there was some indiscriminate buying going on, which of course is always true. I saw some on Bed Bath & Beyond, which looks like it's going broke, which breaks my heart because I did really well on Bed Bath & Beyond back in the day. But it's going broke, yet the stock has just gone way up. Can't figure that why it's going up. So, will that continue for the rest of the year, the market going up like it is? Well, I think a lot depends on the Fed and its outlook on inflation and the labor markets. One of the things the Fed wants to have happen is that the labor market cools off. Of course, the recession will do that, but it looks as though the beginnings of a weaker labor market are now in place. In an article from Yahoo News, there's a chart of the major tech companies beginning to lay off many of the workers that were hired during the pandemic back in 2020. Microsoft, Google, Salesforce.com, Amazon, and Meta, they've all begun some pretty good-sized layoffs, and they're not the only ones. Others have too. This is kind of what the Fed is looking for. So as perverse as that sounds, that's what they want. So why is the Fed so obsessed with inflation? Well, because inflation is a sneaky, insidious beast that will make your money worth a lot less in a relatively short period of time. Who wants that? I don't. I found a calculator that shows the impact of inflation. You can find the calculator on RL360, International Life Insurance Company website. And so just for the fun of it, I used the calculator, of course. And the parameters I entered were that we had a $500,000 in savings. And inflation was running at around the current pace of 6%. And of course, stayed constant. Well, the effect on my savings was huge. My $500,000 would be worth only about $419,000 in just 3 years. In 5 years, my nest egg would be worth about $373,000. And in 10 years, my $500,000 would be worth a mere $279,000. Now, that's a loss of 45%. That is what inflation can do to your savings. So all those people who think that their money is safe just sitting in a savings account, and because they're not going to lose money in stocks, of course, who's going to do that? Well, they're losing money. They just don't see it. Okay, and the problem is that once you've lost that buying power, it's gone. At least with stocks, at least good stocks, even if they're down, there's a chance that you can get your money back and then some, and in many cases that does happen. So there's another fun calculator you can find at usinflationcalculator.com. It shows you what inflation really did over time. It really did to your savings. So I put in the parameters of an item that cost $100 in 1978. And what I wanted to know is what would that $100 item cost in 1981. The reason I did it then is because inflation was running pretty rampant. So my $100 item in 1978 cost me $139.42 in 1981. That means that 3 years later, I would have had to have made 39.4% just to keep even in 3 years. That's a lot. That's why the Fed is going after inflation so much. They think that's a bigger boogeyman than the stock market going down. So I've got so much more to say, but I know this is running kind of long. So let me just tell you that the bond market had perhaps its worst year ever. I think it was its worst year ever in 2022, and has actually started off 2023 pretty well. Believe it or not, even mortgage rates have come down a little bit from their peak. So I just looked up this morning, and today is February 3rd, I think. It is Friday. And I looked up at bankrate.com, and I found some mortgage rates that were at about 5.5% with no points. So the rates have come down. Not too long ago, those were at 7%. And will they continue to come down? I don't know. We'll see. So here's and although I certainly like the first few weeks of the year, I still believe that in 2023, it's going to be a positive year. But I think the chances of a rocky quarter or two are still in the cards. Still a possibility because I don't think the Fed is done raising rates. Now, why don't I believe that? Well, here's something from Bianco Research and the U.S. Bureau of Labor Statistics, that rates have historically peaked higher than the rate of inflation, as you can see on the chart. So in 1973, the Fed funds peaked at 11%, even though the inflation index, or the CPI, peaked at 7.4%. In 1980, the peak Fed funds rate was 20%, while the CPI peaked at 14.8%. So you can see that the Fed funds always went higher than the peak inflation rate during these times. So far, that hasn't happened yet. Now, if it does, we still have a ways to go. So that's why I'm not so sure that, it's all clear sailing for right now. Well, the other thing is I don't believe that we'll be anywhere near the 20% mark that we had in the 1980s. I mean, that was really pretty high. That's not going to happen. But I do look for rates to continue to go a little bit higher. I think the Fed's going to continue to do that, even at a slower pace. So, you may be wondering why I've got Mr. Bear, Mr. Bull, and Mr. Tiger out right now. Well, I think that the bear market is finally starting to wane. We're not quite done yet, but I think we're getting real close. We may be done. The bull market finally is picking up steam, so hopefully that will happen. And I've got a tiger here. Now, why do I have this particular tiger? This is the University of Missouri tiger, and there's no question in my mind that the University of Missouri, my alma mater, is probably the best college of any. And they are playing great basketball right now, and it's very possible that this team could be in March Madness. I am so stoked about that. Well, that's about it for this week, and that wraps it up for my recap of January. And we'll see you in the beginning of March for my recap of February. Until then, Happy investing, everybody.